Hi, I'm David Traversi, and this is part of our series called How to Sell Your Business. We're still talking about valuation, and in the last episode, we talked about how the overwhelming valuation standard for private companies is a multiple of annual cash flow or EBITDA. In that episode, we spent a lot of time on annual cash flow or EBITDA. And in this episode, we're going to move on to the EBITDA multiple. Once you have an EBITDA clear in your mind, what should you expect as a multiple to be applied to that EBITDA? Well, this is the great question with which all buyers and sellers struggle. And there's no single exact number that can be calculated. Rather, what is negotiated ultimately determines the fair market value of your business and the price at which you will sell your business. In general, private companies sell between 2 times and 10 times EBITDA, with the majority of transactions in the 4 times to 6 times range. Therefore, a company with annual EBITDA of 1 million is generally worth between 2 million and 10 million, and more likely between 4 million and 6 million. There are, of course, outliers where companies are worth more or less than this range. Okay, but this is still a very wide range. So how do we narrow this analysis? As a seller, you will want to prove the following to achieve the highest multiple, hopefully even higher than the high end of the normal range. You'd like to show that there's some comparable public companies out there, because as we talked about earlier, comparable public companies will set the high watermark for value in your company. The reality is that the buyer will argue that public companies are not true comparables, given they're usually larger, much more liquid, and far more transparent and regulated than private companies. But it's always good to know the high water mark. You'd also like to show that there are comparable private companies. When I say comparable private companies, I mean private companies that are as similar to your company as possible in terms of business model, growth prospects, size, profitability, geographic location, and that these comparable private companies trade at the high end of the range. Now, this is very hard information to find, but well worth the effort. Talk to everyone you can in your industry, people such as operators, owners, accounting firms, lawyers, business valuation firms, trade journals, and probe deeply in the online world for supporting data. You'll also want to show that your historic and projected growth is strong. In other words, at least 10% and preferably 20% or more annual growth in revenue and profits. In our example, Patty's PPP has grown its customer base and revenue by 20% each year for a number of years. You'll also want to show that your revenue is of a recurring nature, meaning it is largely in place from prior years and can be expected to continue without a huge sales effort or a high degree of risk. In our example, it would be very helpful for Patsy if she can show that, for example, only 5% of customers leave each year. You'll also want to show that the product or service is uniquely valuable and not a commodity. The more commodity-like the product or service is, the more likely a potential buyer will say, well, why buy a business? I'll just start one, which will, of course, lower your pool of potential buyers and hence the price of your business. In Silicon Valley, companies talk about their intellectual property or IP, which can be anything from highly unique knowledge or skills to patented products. IP is thought to be a proprietary and protected form of revenue and profit and hence more valuable than a commodity. You should work on how to portray your company as having more IP and being less of a commodity. In our case study, Patsy may make the case that her systems, which include an online reservation system, an online or app-based progress report so that customers can track the progress of their pet's session, videography of the services provided, and delivery of a digital report card to customers, that these all constitute proprietary IP not easily replicated. And finally, you'd love to show that you're not purely a provider of professional services. The issue with professional services firms is that the value of their businesses, in other words, their people, walks out the door each night. So given the flight risk of the core value of the business, no one wants to pay too much for the business in which they operate. This is why law and accounting firms do not trade at high multiples. In fact, they usually trade at the bottom of the normal range. An example, though, of where a services firm could trade at a higher multiple is where it possesses a unique skill and market position that would be hard to replicate. Several years ago, we ran across a law firm that was known throughout California as the best firm to procure temporary work visas. Their reputation and processes and procedures allowed them to price their firm well into the normal multiple range instead of well below it where a local general law firm would normally trade. Thank you, and look for future episodes of How to Sell Your Business.